Hi class. In this video we're going to look at some of the homework from Chapter 9. So we're going to do this a little bit different than some of the past videos. Chapter 9 covers a lot of materials, and there's several different types of problems in the homework. So I actually have these there. These are finished versions of similar problems that are in your homework. So rather than type them in and talk through them, I just want to point out some highlights in these so that you have some information as you do your homework. So in this one, this says the following transactions took place at Eddie's Sports Gear during the week of October 2019. Looks like we've got 5 transactions, and a cash receipts journal. Now, of course, when you start your homework, you're going to have an empty journal, and you'll have to fill out this information. Just kind of looking at the cash receipts journal, you got a date and description over here. This is just informational, and this information comes from the explanation of the transactions above. But then you'll notice, starting from here and then all the way over to the right of your screen, you're going to have columns that mostly are specific accounts, and specifically either a debit or a credit. So this is a cash receipts journal. So there is a column that is cash debit. So remember, anytime you receive cash, you're going to debit the cash account. So that kind of makes sense. This is cash receipts, got to have a cash debit column. And in a cash receipts journal, every transaction should have a cash debit. Now, every transaction might not have some of these other columns, but each one should have a cash debit. Now, we've got 3 different credit accounts here. We've got accounts receivable credit, sales tax payable credit, and sales credit. So you can kind of tell by looking at this that this cash receipts journal is designed to mostly record sales of something. We've got a sales credit and a sales tax payable. And so when people buy something from us, then of course we would record sales and sales tax. And then if they paid us cash, which this is cash receipts, so for it to be recorded here, they'd have to pay cash. For credit sales, this cash receipts journal is only going to record payments that were made on credit. So then there's a section called Other Accounts Credit. Anytime we receive cash, and it's not for a payment on accounts receivable, and it's not for a cash sale, it's for something else, and usually those are kind of odd things. We don't typically get cash for anything besides sales or payments on credit sales. But we have these columns that we can kind of work with as kind of a catch-all. So let's just look at a couple. The first one says, has cash sales of $4,800 plus sales tax of $384. There was a cash overage of $11. So here you got that information. We know that we had cash sales of $4,800. So if we sold stuff for $4,800, we're going to record that in a revenue account, which is our sales account, and it's going to be a credit. We also record the sales tax because we're going to collect the sales tax at the time of sale. So if you think about when you go to the store and you buy something, you pay for the item plus you pay for the sales tax. So this is kind of like that, except for it's a whole lot of people's sales lumped together like for the whole day. So here's the amount of stuff we sold plus the sales tax. So these two added up should be the amount of cash that we have. But this says that there was a cash overage. So we didn't actually collect the amount of sales plus the sales tax. We collected the amount of sales plus sales tax plus $11. So over here, this is our cash over or short, $11. And this is actually the amount of cash that we received, which was $384 plus the $4,800. And then plus the $11. So we actually add all 3 of these up to tell us how much cash. And you'll notice there's a debit here. This is a credit. It says credit right there, credit and credit. So our debits and credits should be in balance. I'm going to jump down to the very last one because it also has a cash overage or shortage. It says had cash sales of $5,600 plus sales tax of $448, and there was a cash shortage of $19. So this one works the same way, except for the first one there was an overage, and this one there's a cash shortage. I did want to point out, see that one is a minus. That is because it is a cash shortage, and this actually indicates that this cash short or over account is going to be debited. So it's like a negative credit, because all of these are credits. That's going to be a negative credit. It has to be the opposite of an overage. So we're going to record it as a negative. And so when we recorded this in the journal, I'm sorry, in the ledger, we would have a credit for this one, a debit for that one. The rest of them are pretty self-explanatory. Here's one that has an other account, and that's one of those odd circumstances where you received cash and it wasn't for a sale, it wasn't for somebody paying off a bill. This is actually for Eddie Reynolds making an investment into the company. So when you're using this two sets of columns, you're going to put the account name and then the amount here. All right, let's look at another one. So this one is similar. We just look at the cash receipts journal. This one is a cash payments journal. So this one is used to record anytime we make a cash payment. So as with the cash receipts journal, we have a cash column over here, but this is for cash payments. So of course this is going to be a credit to cash, and every transaction that's recorded in a cash payments journal should have a credit to cash because cash is going out. We're paying cash. This one works mostly the mechanics of this one works a lot like the first one we looked at. We've got information over here that we're just going to get from the list of transactions, and then we've got columns that have titles. So we've got cash credit, purchases discount credit, accounts payable debit. So those three are specific, and then we have it. This one has also that other accounts area. This one is a debit. And in this one, just like the last one, you're going to put the account name and the amount if it's for something that won't fit in purchases, discounts, or accounts payable. So that one's pretty straightforward. So let's jump over to another one. All right, so this is a bank reconciliation, and this one is one that sometimes gives students some problems. And of course, when you look at yours is going to be mostly blank. You're going to have a few titles on here, and we've got to fill in some boxes. So let's just look at this. It says DeStefano Office Supply Company received a bank statement showing a balance of $67,855, and that was at the end of March. But the firm's records showed a book balance of $69,469. So there's a difference in what the bank says we have in the bank and what we say we have in the bank. So the purpose of this problem is to figure out, well, what is this difference, and is it correct that we have a difference? And usually it is correct that we have a difference. It's very common for the company books not to match the bank's books, and usually that has to do with some timing differences. Just think about if you get paid and you actually have a paycheck on Friday evening and you run by the bank and you drop it in the night deposit box. Well, in your record, you may have put down that you made a deposit. And so you have recorded that money that you put in the bank on Friday evening. But if the bank was closed and you dropped it in the night box, the bank's not going to record that till Monday. So there's a timing difference in when the bank gets something and when we actually record the transaction. And the same happens with checks. If you write a check and put it in the mail, you know that money has gone out and you've recorded that, but it might not get to the bank for a week. So the bank is not even going to know you wrote a check until after it gets through the mail and somebody tries to cash it. So it's common for there to be timing differences. So, but we want to always check and make sure that we can explain those differences and that they're legitimate, that they're not due to an error. So that's what we're doing with the bank reconciliation. So let's look back up here. We've got some differences that are explained up here, and we are going to record those differences in our bank reconciliation statement. So let's just look at it for just a minute. You'll notice up here it says balance on bank statement, and all the way down through, well, about halfway down, we're looking at the bank statement, And we're going to look for things that the bank is going to get eventually, or they should have, but that maybe because there's been a timing difference that they don't yet have them listed on the bank statement. So most of the time, and that's going to fall, those things are going to fall in two categories. One's a deposit in transit, and that simply means that we put a deposit in the bank and the bank hasn't recorded it yet, probably because they were closed, or um, maybe it was late in the day and they just didn't get it recorded. So deposits in transit are going to affect this part of the bank reconciliation, and then checks that are outstanding, and that it just means that we wrote a check and it hasn't cleared the bank yet. So those are the two things that typically you see on this side of, or on this section of the bank reconciliation. The other thing that you might see, but isn't very common, is if the bank makes an error. If they mess up a check somewhere, then we'll have to account for that. In the bottom, we start with the balance in the books, and then we've got this whole section where we're looking at and recording things that the bank has recorded, but that we might not have recorded. So let's just like kind of walk through this. So the balance on the bank statement is the $67,855 that it gives us up here, and that's just a matter of fact, that's what was showed on the bank statement. Then we're looking for deposits in transit, or bank errors, or outstanding checks. So this first one says a debit memorandum for $47, which covers the bank's collections fees. That's something that we found out about because it's on the bank statement. The bank has taken that out and they have recorded that. So we don't have to, we can skip that one. That's not a deposit in transit. It's not an outstanding check. It's not a bank error. So it doesn't fall in the category. It doesn't get recorded on the top part of this bank reconciliation statement. The second one says a deposit in transit. So that's a deposit that we put in the bank, but the bank hasn't recorded yet. So we're going to take this $3,550 and record it as an addition to what the bank says we have. Because at some point, the bank's going to open back up. They're going to get that deposit, and they're going to record it, and it's going to increase this balance. So it falls in the additions area. Number 3 says a check for $245 was issued by another firm and mistakenly charged to DeStefano's account. So that's a bank error. So probably when DeStefano was looking at the bank statement, they saw a check on there for $245 that came out of their account that they didn't write. So that's a bank error. And we've recorded that bank error in the additions part. And the reason is, when we see a check that's taken out of our account that shouldn't have been, we're going to call the bank and say, hey, you took out $245 out of our account, and it should not have been, and the bank's going to fix that. And to fix it, they're going to put that money back in our account. So that's why it's here. They took it out by mistake, so here we're adding it back in, and we're going to straighten that out with the bank. All right, number 4 says a debit memorandum for an NSF check showed up on the bank statement, and that's on the bank statement. The bank has recorded that it's an NSF check, and the only way we would know it's an NSF check is if the bank told us. So that we can skip for now. And number 5, we've got 2 outstanding checks. So those are checks we wrote that the bank hasn't received yet, but at some point they're going to receive those and take those out of our accounts. So there's our outstanding checks. We put both of them in the amount. And at that point, and they've actually got this set up so it'll add up for you. So you're going to take the beginning balance and add the additions, subtract the subtractions, and that gives us an adjusted bank balance. So then we're going to start with the second half of the bank reconciliation. We're going to take the balance in the books, which was given in the instructions. We're going to type that in. And if you like to mark these off as you go, or kind of think about them as marked off, that's just kind of an easy way to keep track of what goes where, because all 6 of these things are only can go in one part of the bank statement, or the bank reconciliation statement. So once we record them, we're done. So we've already recorded number 2, number 3, and number 5. So we're finished with those. So that leaves us number 1, number 4, and number 6. So those things we're going to record in the other half of the bank reconciliation statement. So the debit memorandum, we need to record that the bank kept $47 out of our account because they used it to cover a fee. So that actually reduced we had a balance in our books. That $47 fee it actually reduced the amount of cash we had. We just haven't recorded it yet. So that's a deduction. I'm going to put that right here. And let's see, number 4 says a debit memorandum for an NSF check of $6,120 issued by Wozniak Construction Company, a credit customer. So that just simply means that Wozniak Construction Company was our customer. They paid their accounts. We had an accounts receivable for them, and they made a payment on that accounts receivable, but the check didn't clear the bank. It bounced. It was a bad check. So when that happens, the bank's going to take that money back out of our account. So we're going to look down here, that NSF check that the bank took back out of our account. We need to do something with that on our records as well, because we need to record that. Wozniak Construction Company still owes us some money because their check bounced. And then the last one says a credit memorandum for $6,150 was a note receivable that the bank collected for the firm. So that's another one that we need to record in our books. So there's that note. We're going to add that because the bank collected it for the firm, put it in our account. So if we take the balance in the books, add this note, and then subtract these deductions, we come up with an adjusted book balance. Now, the whole thing the goal of this reconciliation is to come up with two account balances that match. So we should have an adjusted bank balance that matches the adjusted book balance. If you don't, you've probably got something in the wrong place. All right. So the next thing that we have to do is do the journal entries that are associated with the bank reconciliation statement. So I said that there are two sections in this bank reconciliation. The top part is the bank part, and the bottom part is the book part. Anything that's up here at the top, we have already recorded because we initiated those transactions. If it's a deposit in transit, we've already recorded that. Those checks that we've got here in the deductions area, we already wrote those checks, so we've recorded those. So we don't need to record anything else. The only thing we haven't recorded is that check that they incorrectly charged to us, and we don't need to record that because they've got to straighten that up. That's their problem. So you can just, when you're thinking about journal entries off of a bank reconciliation, you can just skip the whole part at the top because there's no journal entries for the top part. At the bottom, you're going to have to make a journal entry to record everything that you adjusted in the bottom section. So we had 1, 2, 3 adjustments. So we'll have to adjust all 3 of those. So Connect is going to actually give you 5 scenarios. The first one asks you to record the bank fee of $47, and they're calling that a miscellaneous expense. That's just the account that they chose to use. I probably would have called it a bank fee expense, but they don't have that in there. So use miscellaneous expenses, and it came out of cash. It was a deduction. The second, the third, and the fifth are those 3 things that were listed up here on the bank part. So those are that's kind of a trick question. You don't have to record these because you've already done those. So number 2, number 3, and number 5, you don't have to record. And then here is the accounts receivable that for that check that bounced, and they took the cash back out. Oh, I thought there was another one. There's the other one. And then the last one, number 6, is for your note receivable that the bank collected for you and they gave you the cash. So that's how you're going to approach that one. Let's look at another one. All right. So this says we've got some cash payments. We've got some ledger accounts up here. We've got transactions, and it tells us to do these things step by step. And this one's pretty long. There's a specific part I wanted to look at, and that has to do with the petty cash because this one's a little bit different than some of the other questions. So down here we've got several tabs. Whoops. We've got a general ledger tab, a cash payments tab, which is a cash payments journal, and we looked at one of those already. This one's just a little longer. We've got a petty cash analysis, which is something new, and an analyze question. So I really wanted to look at the petty cash. So if we look at the transactions, and we're going to skip most of these, we're going to find just the ones that had to do with petty cash. So up here on the 4th, it said we issued a check for $150 to establish a petty cash fund. And it says journalize this transaction and enter it on the petty cash analysis sheet. So when you get to that one in the cash payments journal, let's see where it is right here. So you've got your information here. You're paying out $150 in cash, and it goes into the petty cash fund. And there's the $150 that goes in the petty cash fund. So the entry on the cash payments journal looks pretty much like the ones we did before. The other thing you have to do is come over here to the petty cash analysis, and you're going to record that establishing the fund in this sheet. And there's our $150 that goes in there. That just simply means that we've put $150 in our petty cash box or envelope or whatever we're keeping it in. All right. So then there's several. I should have said over here. There's several petty cash transactions. Let's see, the next one's on the 5th. It says paid $23 from the petty cash fund for office supplies, petty cash voucher number 1. So when you get to those petty cash transactions, except for the one to establish the fund, you don't need to put it on the cash payments journal yet. So there's the here's the established petty cash fund, and then you'll see there's no other petty cash right through here. You don't have to do that. You're just going to record them on the petty cash sheet. So here's our office supplies. We paid $23 for it. And you can kind of see we've got these other accounts out here. Supplies debit, delivery expense debit, miscellaneous expense debit, and then that other accounts debit. So how this chart works is that you're going to put the total amount of the payment under the payment, and then you're going to break it out by, well, what expense account did it go to? So it could go to 2 or 3, but most of the time it's just one. So this $23 is a supplies. We bought office supplies, so it's going to go under the supplies debit. So the total of these columns over here should equal the amount in the payments, if that makes sense. On the 8th, it says paid $13 from petty cash fund for postage stamps, and they want you to put that miscellaneous expense. So here's our postage stamps. Here's the total payment of $13, and then it said to put it under miscellaneous expense. So there's that. So that's how you're going to do each one of these. We've got a delivery expense. The only one that's different is this personal withdrawal. And that was on the 22nd. It says paid $17 from the petty cash fund for a personal withdrawal by Larry Jennings, who is the owner. So this part looks the same. We got a personal withdrawal. It's a payment of $17. That Larry Jennings drawing account is not listed up here, so you're just going to put in that other accounts debit. And you're going to finish all of these, and once you get finished, there should be some totals here. Now this part at the bottom you actually have to fill in. So after it calculates the totals, you're going to have a balance on hand of $37, and that $37 is just the difference between what you put in there, which was $150, less what we paid out for stuff, whatever we bought, which was $113. So we've got $37 left. Once you put that $37 left, it brings this in balance. So this one is auto-filled. And then these 3 lines at the bottom are kind of just summarizing what we had plus what we're going to put back in there. So our balance on hand is the $37, which comes from up here. We're going to put $113 back in because that's what we spent. So then we would have the $37, which we have, plus the replenished fund of $113, which gives us a carried forward amount of $150, which makes us back, it kind of resets it back to what we had to start with. All right, so that's how you're going to do the petty cash analysis sheet. The cash payments journal. All of these other transactions are going to go in the cash payments journal just like you did before, with the exception of the one on June the 7th. That one, we paid a note plus interest, so it's the only one that actually takes up 2 lines. Let me scoot over a little bit. So you'll see the notes payable here. We paid $2,500 in a note plus $100 in interest, so we actually paid $2,600. There's that cash payment, and then these debits actually add together to keep us in balance. So this one takes 2 lines, and you'll see there's a little bit of blank space there. Now, the only other thing on this problem that I think will give you problems is at the bottom. Well, let's look at the instructions. On the 30th, it says issued a check to replenish the petty cash fund. So that's where we're putting that $113 back in to our petty cash. So to record that, you're going to replenish the petty cash fund. And this one takes up several lines also. And the amounts in these you're going to get from your petty cash sheet. So go back over here. We've got a supplies debit, a delivery expense debit, a miscellaneous debit, and then an other accounts debit. So you're going to take these totals and record them as these expenses, and then we've got this one that's kind of different by itself, but it's you're going to take that account, and that's a debit also, and you're going to record them over here. So you'll see here's our supplies debit, our delivery expense debit, our miscellaneous expense debit, and then there's that Larry Jennings drawing debit. So these are all the debits that come off that petty cash sheet, and then the credit is to cash, and that's what we put back. And this the $113 equals the total of these things. So if you follow that process, I think you'll be fine. Let's see, where are we at now? There's only one other one I wanted to look at quickly because it's got a little bit of quirkiness to it. Sorry, my internet is a little slow today. Okay, this one is another bank reconciliation. You only have the half of it. It's just the top part of a bank reconciliation. There's a couple of errors that you're dealing with in this one. So it says in the first one, there was a check that was issued for $715 to make a cash purchase of supplies. However, examination of the canceled check on the bank statement showed the actual amount of the check was $24. So we recorded it as $715. Should have only been $24. And it says it was for cash for supplies. So we would have debited supplies for $715, credited cash for $715. And then the second one says we had a check issued for $130 to pay a utility bill, but it was actually for $184. So we've got some amount differences there. I think the tricky part of this says if the errors described had not been corrected, would net income for the period be overstated or understated and by what amount? So mine is overstated by $54. And let me just show you where that comes from. I would do the bank reconciliation and then do the journal entries. And these journal entries are your correcting entries. They're fixing those two problems that I mentioned. So to answer the analyze part, it says, how much would net income be changed, basically? So you have to think about, well, what is net income? Net income is made up of revenue and expenses. So I would look at the journal and find the things that affect either revenues or expenses. So in this first one, our correcting entry had to do with cash and supplies. Those are both asset accounts. Asset accounts do not affect net income, so those we can ignore. In the second entry, we have a utilities expense and a cash, and those are the two accounts that were affected. Cash, again, is an asset account, so we can ignore that. Doesn't have anything to do with net income. The only one that has to do with net income is that utilities expense. And that utilities expense changed the net income by $54. So that's where that comes from. So that's just kind of an overview of Chapter 9. As always, if you have questions, let me know, and I'll be glad to help.